Understanding risk tolerance in investment. This document explores the concept of risk tolerance in investment, which is crucial for making informed decisions about where to allocate funds. It delves into the factors that influence risk tolerance, provides examples of different risk levels, and offers insights on how to assess and potentially increase one's risk tolerance. Understanding your risk tolerance is essential for creating a balanced investment portfolio that aligns with your financial goals and comfort level with market fluctuations. What is risk tolerance? Risk tolerance refers to the amount of loss an investor is prepared to handle while making an investment decision. Several factors determine the level of risk an investor can afford to take. Knowing the risk tolerance level helps investors plan their entire portfolio and will drive how they invest. Determining your risk tolerance. Risk tolerance is the amount of market volatility and loss you are willing to accept as an investor. Determining your personal risk tolerance is perhaps the most fundamental step you can take in deciding what types of investments to make. Examples of risk tolerance. Moderate risk tolerance. A classic example includes the traditional 60-40 allocation between stocks and bonds. This strikes a balance between some money invested for growth, stocks, while maintaining an eye on stability for income generation, bonds, at the same time. Understanding investment risk levels. Your risk level is how much risk you are willing to accept to get a certain level of reward. Riskier stocks are both the ones that can lose the most or gain the most over time. Low risk tolerance investment. An aggressive investor, or one with a high risk tolerance, is willing to risk losing money to get potentially better results. Conversely, a conservative investor, or one with a low risk tolerance, favors investments that maintain his or her original investment. Risk tolerance limit. Risk tolerance is defined as the acceptable level of variation in performance relative to the achievement of objectives. This defines the specific maximum risk that an entity is willing to take regarding each relevant risk category. How much investment risk should you take? As a general rule, if your investments can ever drop in value by 20 to 30%, it is considered a high-risk investment. It is also possible to measure the risk level by looking at the maximum amount you could lose with a particular portfolio. Measuring risk tolerance. Risk tolerance is influenced by some measurable factors, including the client's time horizon, age, income, and family circumstances. Others are less quantifiable, like clients' personalities, their responses to real or potential losses, and their long-term goals and priorities. Increasing your risk tolerance. Don't fear risk, understand it. Go after the data. Commit to the jump, and work backward from the worst-case scenario. Share your risk mindset. Lean into your principles. The nature of investment risk. Investments can rise or fall in value. So, just as you can make money through investing, you are also at risk of making a loss. This is why investing is riskier than saving. Safe investment options. While no investment can be guaranteed as completely safe, for those seeking low-risk options with relatively high returns, bank fixed deposits, FDs, savings accounts, and public provident funds, PPFs, are considered safe choices. Safest investment options for 2025. Here are some of the best low-risk investments. Short-term certificates of deposit. Cash management accounts. Treasuries and tips. Corporate bonds. Dividend-paying stocks. Preferred stocks. Money market accounts. Fixed annuities. Understanding your risk tolerance is vital for making informed investment decisions and achieving your financial objectives.